Copper. China's got some copper. Oh
Does China
man.
not have copper?
I mean, I don't know where. I don't know
Does
where the
China
copper
not have
goes.
copper?
I got some copper in my house right now. You gonna come cut out my pipes? Is that your investment?
Skippy needs pennies. Doogles buys
Yeah.
copper.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Hey there, sir.
Are you a rap artist?
Dude.
That is amazing.
No, so I got I'm trying to figure out my setup here. So I think there's going to be some reverb going on in the room.
You got a shot, I assume.
Yep. Got the first shot on Monday, which felt like I don't know, like an adrenaline rush. I'm like 10% superhero right now.
Your behavior is starting to get a little more risque.
Oh, dude, you know how many parties I went to? Zero. But it doesn't feel any different with regard to like a behavior or anything like that. But it feels like the start of a new era potentially.
Let's just kick us off real quick, just with the shout out to my boy Roy Williams. Hell of a career, and go ahead, Douglas.
You know I support the Blue Devils, so it's sorry you go out in the first round. We talked about going out on top. Is this how you do that?
Let's talk about that a little bit. Let's talk about 33 years worth of coaching for Roy versus Coach K. Much better winning percentage, more conference titles. He basically, if you do ratios of
how many Olympic gold medals
titles and national, Roy does not have an Olympic gold medal. Do you know why? Because he likes to golf.
All right. This is a false narrative you tell yourself to keep yourself calm.
That's right. All right. We better jump into it. So what's on the agenda today?
You want to start off with a quiz? We gotten fun with the quizzes?
Oh, do I ever? Yeah. This is for me. This is to make me look like an idiot.
Well, I'm not going to drop a quiz for myself. That would be quite interesting.
All right, go.
So let's do it. So last week we talked about how you got to stay the course, right? And I talked a little bit about recent performance of my portfolio and then how that mapped historically. Well, after that, I don't know if he felt me, but I'm going to assume he did. Maybe listen to the podcast. Ben Carlson dropped an article called "Owning the Best Stocks is Hard" on his blog, A Wealth of Common Sense, which kind of follows its similar theme. And so I'd love to drop just a handful of names at you, and I want you to tell me what their biggest drawdowns, their biggest drops were.
Oh, I'm so excited about this. Hit it.
Ready for this? So yeah. These are high flyers. Amazon, after the .com bubble.
88%.
95%. But I mean, yeah, direction. So since then, Amazon's also had two 50% plus drops and 25% plus drops. Microsoft, after the .com bubble.
74.
75. Okay.
Oh man.
Look at you.
Oh man. Look at that.
You. You've been reading your investor amnesia.
I know this stuff.
And so Microsoft took 17 years to get back to its 1999 levels. That's how crazy that bubble was. Netflix, which we all know, one of the best performing stocks over the last 20 years. What was its decline? This is not after the .com bubble because it didn't go public till 2003.
Gosh, it's like, I think it's in the 80s.
Yep, it's about 80%, a little over 80% decline in 2012. So just 9 years ago, folks could have gotten quite the discount on that, but you never know at the time. So, and Monster Beverage up 125,000% since it went public. One of the hottest stocks the last 20 years too.
Yeah, so Monster, one of the best performing stocks in the last 20 years. Absolutely. I see this chart all the time. This is a very popular chart. Popularized by Morgan Housel, actually, not Ben Carlson. So, but I think the chart actually came from Michael. Oh, I'll get the name. I'll throw it on the Twitter. No. It's an Excel.
Jordan?
All right. So I'm totally guessing this one. I don't know, but it's significant. Even the best performing stock or one of the best, I think it's still in the 80s.
It's fallen 60% plus 4 times. And 2 of those, it was down 90%.
Yeah.
I'll tell you what this is and what this is not, though, just to be clear. This is as we were talking about last time, if you have a investment hypothesis, right, backed by data, you have conviction, and you're following a philosophy, stay the course. It's not saying like, no matter what's happening, don't do your analysis. Don't always assume things are going to bounce back, right? You talked last time about how there are some stock markets that have gone to zero. The US stock market's always rebounded, always gone up. And since 1980, 40% of all US stocks that have experienced 70% plus declines have not come back to even, right? So stocks do go down and not. But the point, I thought this article was really interesting because it was feeding a little bit off of what Bill Gurley said in the recent Masters in Business interview. Did you listen to that one?
I haven't caught that yet.
No,
I will, though.
It's good. Barry Ritholtz has a podcast called Masters in Business where he interviews just big folks in investing and business. And he interviewed Bill Gurley, early Gurley, as we talked about last time, Bill Gurley recently. And Bill Gurley was saying that that basically it's hard to own. He was specifically talking about Amazon, but he was saying like it's really difficult to stay the course with some companies like this because you might see a 3x increase, right? And you say, oh, I want to sell, right? That company like Amazon's a rarity, right? But might go up by orders of magnitude bigger than that. And Ben Carlson is saying it's also hard to own these stocks for the long term because they have these really significant drawdowns. Like you lose 90% of a stock. You have to really believe in that or be a long-term investor.
Yeah, there's so much going on there, right? One is it speaks to diversification because it would have been idiotic for you to put 100%, not you, but someone to put 100% of their portfolio in Amazon in, say, 1999, and just when they're down 90+%, just be like, oh, it's cool. I'm good. There's no chance of failure here. And then just to ride through it. So that speaks to diversification. It also speaks to something I think we've talked about before, but I've definitely written about it. Great companies aren't great investments, right? So you mentioned how long it took Microsoft to get back after their massive drop. Same with Cisco, same with a bunch of other good companies. You have to keep valuation in mind when you purchase the thing. But what I love about it is there's lots of purchase opportunities. So you can get these great companies at sometimes as much as 90% off a valuation that probably started that wasn't a fair valuation. It was probably overvalued when it started, but it still comes down 90%. Now, the other thing that I feel like is just important to mention is I'll probably get the phrase wrong, but a lot of times you go broke trying to catch falling knives, right? And something that's down 80%, if you purchase is down 80% and it actually continues to get down 90%, your investment just got cut in half. So this is not an easy thing to do. And that negative momentum is tough to flip. And I know well because I'm the idiot who buys this stuff and calls it a value investment, right?
Yeah. When you play with falling knives for quite a while, I guess maybe you get used to how to juggle.
Maybe.
So thanks for participating. I thought that was pretty interesting and important like psychological lessons as we talk about a lot here. I think just to keep in mind while you're thinking about your picks. Quiz down.
Let me tie that to something I want to button up from a few weeks back. And this is a little bit of a quiz for you because I want to see what comes off your head. So we've talked about hedging and purchasing bonds, and you were on a commodities kick and everything else because of the current valuation of the US stock market. It's expensive. Basically everyone that's looking at valuation metrics knows we're in a bubble. You just don't know when it's going to pop or if it's going to pop or if it's just going to slowly die off or whatever, right? So we've been talking for a long time about what you do with that information. One thing that I feel like we really missed, and I'm sorry we missed it, is thinking outside the box a little bit. What were you telling me last week that I don't think outside the box?
Yeah, you're trapped in that box.
Let's see if you're impressed or if I'm still trapped. So let's say you have $1,000 sitting around, or maybe you have $10,000 sitting around, or maybe you have $100,000 sitting around, right?
Scrooge McDuck.
My boy. Oh, I love Scrooge. Actually, I love the little kids. I don't like Scrooge.
Yeah. Huey, Dewey, and Louie. Yeah.
There we go. That's why you're here.
Was that the
type
quiz?
Of knowledge. All right. It's important to think about investments that aren't necessarily equities, ETFs, stocks. Doogles just locked down a house. Doogles, that allows you so many opportunities, and I'm curious if you've thought of any of these things. So I assume a digital thermostat is like table stakes these days. You already got one hooked up?
Nest connected.
Perfect. All right. So for those who don't know, if you want to get nerdy about digital thermostats, the return on investment there is like off the charts. Your payback period is like a little over a year. I mean, run all the numbers. It's a no-brainer. It's one of the best ways you can spend. If you got $200 laying around and you have an old school thermostat, that's better than investing in Amazon.com. It just is. It's a no-brainer investment.
I mean, that feels like an aggressive.
Okay,
aggressive
it was
take.
a little aggressive.
Yeah, maybe
it was a little aggressive.
Yeah, but anyway, yeah. Keep going.
So another thing you could do, I'm not saying I'm doing this, but we've looked at some return projections for a 60-40 portfolio, 60% stocks, 40% bonds over the next 7 to 10 years. Let's say that's like maybe 2% a year. In my place, man, I could throw solar panels on the roof and make about 7% a year. Again, like I don't know. I'm not ready to pull that trigger. But if you're someone that's not ready to go with equities, you could consider something like that.
So
thoughts?
Is this, when you think about, this is kind of looking at a return, not so much based on cost savings versus based on income generation, right? I mean, which is both sides of the same coin.
Same, right? Because if you save $50 a month on your electrical bill for the next 30 years, that's the same as it's better than someone throwing you $50 a month in dividends. And it's probably better than someone throwing you $50 a month in capital gains because of the taxes associated with those sort of things. I just wanted to touch base on this because a lot of times when they throw on the earbuds, our listeners throw on the earbuds and want to hear someone talk investing, you're only thinking equities and the like. But you can be creative here, and in some cases, especially now, it might be the right time to consider that.
Oh, I also, even sticking within, I think it's wise to look beyond equities and think about this beyond equities. And I also think it's really wise to think about this from the cost perspective, because oftentimes that's neglected, even within equities, right? We talked about Bogle, a couple of weeks ago too. And one of the things that Bogle really was trying to shout from the rooftops was you have to think about costs. And if you only look at returns, right? If you look at gross returns, but you're invested in funds even that have 1%, 2% fees, right now you're knocking that off the top. And if you're ignoring, you've brought up tax consequences like a few times here. If you're ignoring tax consequences, then you could be just from the get basically at a disadvantage, right? And one of the things he would say to keep it simple was, if the stock market on average is bringing in an 8 to 10% return, and you're invested in the stock market with something that costs you 2% a year, then you're always going to be behind the market, like even by when you think you're investing in the market, right? So it's important to look at cost for all this stuff. I think it's smart. For the record, revenue minus cost equals profit.
Did that just happen?
Masters in business.
Barry Ritzholtz, by the way.
Oh, it's Ritzholtz?
I'm usually the one butchering names.
Well, we'll see. Maybe it's a silent something in the middle there.
A silent Z, right there in the middle. Okay, so that's my mini rant. LED lights are good. I don't mean this to be all home-based stuff, but just give that some time. There are investments that aren't equities that could have favorable returns right now. Yep, and smart. I will pound the table for a digital thermostat despite Doogles yelling at me.
All right, where do you want to start in the fishbowl?
I want to throw you a few quotes, I think. And I want you to tell me when these came from.
When they came from?
Yeah.
Like name a year?
Okay. This is about young companies and a mindset. Never mind that you weren't actually making money. There'd be time for that later. Assuming someone would eventually figure out how to make money from the internet and really fill in from the service. You need to pile all the revenues back into growth. You just had to show that you were the company of the future, not make money. Let me give you a couple more while you're thinking.
Yeah. This is all from the same place?
Yeah. The most appealing companies became a state of pure possibilities. The new growth theory argued in abstruse mathematics that wealth came from the human imagination. Wealth wasn't chiefly having more of old things. It was an entirely new things. Growth is just another word for change.
Yeah, I mean, I feel like there's like some Bezosness in there, some Gatesness in there. Then when he talked about like obtuse mathematics, I mean that one threw me off a bit. Munger?
Yeah. No, so these
Because
are
he didn't say
actually
most of that.
I cheated, and this is Michael Lewis from that book I just finished.
The new
We talked a
thing?
little bit about the new thing, which is actually the old thing.
There you go.
What I'm trying to convey with these is they're 20 years old, man, and he's doing a really good job articulating how at that time, specifically with Jim Clark's companies, it became about selling, kind of, some would argue, for the first time in like modern economics, that you're selling this idea and the fundamentals mattered so much less. Like with Netscape, it was about, this is where we're going. Who cares if we make money or not? Like it's this vision thing. And so that, to me, pretty much only happens in a bubble when you get that blind faith where people throw money at you. But it also speaks to how Silicon Valley and the internet have changed things, where we're not in a production-based economy necessarily. And so you can sell that narrative more.
Well, I would actually argue that, so I've been in the startup world, right, primarily in my career, and that's just independent of a bubble. That's just that's where you live, especially in your earlier days, because the likelihood of success for any company that's starting is very small, right? I mean, you're in the 90+% failure. So someone has to believe that if this succeeds, it's going to be absolutely huge, right? Is the broad belief, knowing that it probably won't be. And you have to believe in something that doesn't exist today. You're looking at a PowerPoint deck, effectively. Whether you're selling the internet or selling goods, you still have to, if it's goods, right? One of the startups that I was an early employee at was a medical device company, right? So it's still in the world of production, but you have to believe that that you can get the supply chain set up in China. You have to believe that you can manufacture it at the price that we're telling folks we can manufacture it at, which is really low. You have to believe that people will buy it. You have to believe blah, 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 blah. And it's basically selling FOMO. This vision of the world's going to exist. If you believe that vision of the world is going to exist, then you have to believe that we're going to do it. And you have to believe that if you miss out on that, sorry, right?
You'll regret it. FOMO. Yeah. I love that perspective. And there's a reason I wanted to talk about this with you, because it's really good. It's not just about a tangible device or a non-tangible device necessarily. It is about telling that story. I think what struck me, or what I hadn't been thinking about, is how much that storytelling matters. One of the third company, the Halcyon piece, was basically the CEO at the time came in, and his initial plan was, I'm going to ride Jim Clark's name to go public, to make enough money that I can be bigger than people that have real products and actually make money. And then I'm going to buy those companies. And then it becomes a self-fulfilling prophecy. And I just hadn't really, that's not how I think about the world. I'm a fundamentals based guy, and it's such an interesting thing to think through, because sometimes, and I think you could argue with Tesla that this has almost come true. Like sometimes if your story's good enough, it doesn't really matter what's happening within the business, because you eventually outgrow all your problems.
Well, the one thing I'll change there is it does matter what happens in the business, because you're basically trying to make time go past to get to the truth. So your story has to last as long as it takes for you to get there. I'm going to say fake it till you make it, but that sounds more manipulative than I think sometimes it is, at least. But what I mean is, like, your story can't last longer, right, than folks' patience, but it only has to last as long as folks' patience until you get there, right? So if people, we discussed you brought up Tesla, we discussed the time aspect of Tesla. As Vitali said, like, you're ignoring time when you buy into some of these things. And so long as, like, Elon's story can maintain a decade, Tesla could be there. Now, it's a big bet to believe it's going to, like,
it's still nearly impossible if you look at the math.
I mean, because people are looking, like, day by day. And so, and that's part of the danger. To bring this back to the bubble, I think part of the danger in a bubble is people are speculating for days or weeks. So it's hard to tell a long-term story that's going to last in a bubble. It's actually the best time. I don't have stats on this, but I can give a couple anecdotals. Like the best time to start a company is during a recession.
Oh, absolutely.
Because people have, well, there's many reasons, but to tie to this, people have more patience at that point. They're not speculating quite as much during that point, right? But during a bubble, when you're doing that during a bubble, like people want returns real quick because there's FOMO everywhere. But during a recession, right, which is when, if you look at when Uber was started, when Airbnb was started, when Dropbox was started, right, that was all in like the 2007, 2009 timeframe. And so I'm not saying that you have to start during a recession. You can't start during a bubble, because there are plenty of companies that were started during bubbles too. But
yeah, well, and I love your insights on it, but I just don't think about the world that way. And so that was really, really well done. I really enjoyed that read. I'm also reading, and Doogles, you should pick this up, the Acquirer's Multiple. Really simple. Maybe we'll break it down next week, but simple value investing strategies, and a lot of talk on Buffett for the listeners that kind of want that refresher on Buffett. The thing I love about this book is it gives you all the Buffett knowledge and then says, oh, but listen, the Skippy way is better than the Buffett way, and here's some numbers to prove it. So check that out.
Acquirer's Multiple?
Yeah, Acquirer's Multiple. My boy Tobias.
Oh, wow.
Good dude. All right, what's in your fishbowl?
Actually, let's continue to feed off of the non-equity piece for a moment and do like a briefer on Biden's infrastructure plan. Does that work? Okay.
Yeah, I haven't done much of a deep dive, so
that's fine. I'm not going to go through all of the detail that's in here because it's a lot. And to be honest, I mean, this plan has quite an uphill battle to face in Congress, and we might be talking, if it goes through, we might be talking like late summer, fall, or like who knows when we're actually going to know the state of it, because it's got a lot of work. But I'm going to hit on some high level points.
Let me jump in. Can we talk psychology real quick? I love to do this, but like, here's the thing, man. I don't know the bill, but you just spent $2 trillion. Now you come back asking for another 3. Like, it just feels like.
And Biden is coming in hot. I mean, he's only been in office for 2 months, and he's got $4 trillion like that he's trying to YOLO. Like, I mean, it's insane. Yeah, but so this is a $2 trillion plan that he's introducing, which is roughly, these are rough numbers because I kind of added them up myself, so take it for what it is, but directionally it'll be right. About $550 billion in transportation, $325 billion for water, internet, and electric, $380 billion for homes, schools, buildings, and then about the last trillion. So just the last trillion. Do you ever say that when you're on workforce and innovation, right? And it's a mix of, it's called the infrastructure bill, but it's really going back to how we talked about how the stimulus package had some Biden philosophicalness going on in there too. He's throwing in some like anti-racism, community-based care like stuff in here too that he's putting in infrastructure, which I guess you could in the loose definition of infrastructure, you could include that stuff because it's like human infrastructure, right? What we typically just think of like hard infrastructure. But yeah, to give some highlights, there's a bunch of electric vehicle investments, a couple $100 billion. There are things about water systems, high-speed broadband, affordable housing. There's all sorts of things in here. What I'm gonna again, it's gonna take a while, so we'll have to figure it out. But the things that are of most interest to me, and when I say interest to me, I literally mean interest to Doogles, not like what I think is gonna have the biggest impact. Are a couple. One is, I think workforce development stuff is fascinating. And so with workforce development, I mean, there's so much that could mean and end up going into. And I personally think that there's just a lot of opportunity this is from more of like a startup investment perspective. I think there's a lot of opportunity in how we get people participating, as we've talked about, both in the labor force and the capital markets. And so I think there's some interesting stuff that I'm going to like dive into the detail there to figure out what it might mean.
Did we talk? I think we missed it. Did we talk about the Google basically certificate program?
We mentioned it like for a sentence.
Good. Yeah. So but similar to that, is that what you're saying, Doogles, or it?
Yeah, I think that's in the same vein. It's like if you look at workforce development generally, it's investing in training and education for it, and opportunities on the other side. So I think that there's a lot of room for like if you look at the talent market, like generally, how do you connect people with jobs of the future? How do you train them and then connect them with jobs of the future? I think there's a lot there. So that's one place. The other is,
sorry, I want to interrupt though, like, because this is fascinating. And I know you have expertise here. Like, is that something where we need government intervention to be better, or can the free markets fill that?
The question of need, I think, is always interesting. I think it's the speed and the tolerance for ROI. I think is generally what often can be looked at if you say, do we need? In the end, I believe the private markets will end up being the people that deliver on this stuff, right? But sometimes you need a little nudge from the government, or maybe not need. Sometimes it's good to have. So I think this is one where it's great to have. The other areas going into your non-equity, right? There are a couple like tiny Salt Bay investments I talked about, and we oftentimes, right, as you've mentioned, this podcast is us talking about interesting stuff. This is one where I'm thinking about putting a little bit more down, right? Which, look, folks out there, you make your own decisions, right? And think about this for yourself, because it may not fit into your portfolio at all. It may not fit into my portfolio in the end, but I put we have a couple copper holdings, and one holding around uranium, thinking about nuclear energy, and one holding in a renewable utility, basically. And those four I'm actually thinking a lot more about, because I've put like smaller, I wanted to see what was happening and like just kind of be involved a little bit. So I put small bets in them. But on the copper side, and this is speculation galore, right, around this, but basically a lot of what's been driving copper recently has been China, and China saying like, we need copper for infrastructure. And so China's been like the main consumer of copper. If this ends up going through and we're investing in a lot of infrastructure here, the US is going to need a lot of copper, which China is going to have. And I think the price for copper could just go insane in that world. And so that's speculation, but I'm thinking about putting a little bit more there. And then nuclear energy, clean nuclear energy, something that Biden is going to be betting on. So I'm thinking about putting a little bit more in uranium. And then so those are both like short-term, thoughts a little bit. The renewable energy utility that I'm invested in is a long-term play for me. But I'm going to analyze. I'm not going to do anything immediately, because I want to see how the talks for this like kind of keep going and what we actually do.
I can't sign off. I can't sign off on any of this speculation.
Uranium,
copper. China's got some copper.
Does China not have copper?
I mean, I don't know.
Does China not have copper?
I got some copper in my house right now. You gonna come cut out my pipes? Is that your investment?
Skippy needs pennies. Doogles buys copper.
Who cares about running water, man?
I know. But there's some interesting stuff in here, though.
Well, like, what do you think is gonna happen? I mean, are they gonna that cool trillion that's like not traditional infrastructure? Is that gonna get put on the chopping block, you think, or do we even know at this point?
I mean, it's hard for me to believe that $2 trillion are going to come out the other side of this. I think independent of what ends up getting cut, like that's just, to your point. I mean, in 2 months, you're like spending a lot, and we've got, politically, Congress and is Democrat. Like if you just look along party lines, but neither the Republican Party nor the Democratic Party are homogeneous, right? And so you've got some people that are screaming, this is not enough. Why isn't it 5 trillion? And you've got people that are like, have you seen our balance sheet recently? Like, can we let this simmer down now? So like, it's gonna be hard for 2 trillion, independent of what
we handed
come out the other side.
Biden the credit card, and he's trying to put 4 trillion on it at Nordstrom's. Man, are Nordstrom's even around, or have they gone out of business? A bad analogy.
I saw one.
Anyway, you saw one. We think they're still alive.
It was next to a Heckinger and a GameStop, so it's kind of hard to understand.
I guess this is not political, because we try to steer clear of that. But here's the disappointing thing to me. We've talked in previous episodes about being smarter about the return on investment that we get with our government funds. And a lot of this stuff is really good. Like, how cool would it be to have a countrywide train system like as part of this bill? And a lot of the infrastructure is way far behind. You talk about bridges, roads, whatever. There's probably some good investments in here. But what's disappointing to me is there doesn't seem to be like hey, we're spending all this money over here in a way that's not the wisest. And so we're going to reallocate some of our current budget. It seems like we're just saying, we need more taxes and more money and everything else, not be smart. And listen, I understand how politics works. I understand people get mad and jobs get lost if you cut budgets elsewhere. So it's hard to do, but that doesn't mean it's not the right approach.
Yeah. And I didn't mention this, but to your point, like a lot of the funding for this is supposed to come from increasing the corporate tax rate. And corporate tax rate and private citizen tax rate for people over $400,000 a year. So yeah, I hear you. And on the political front, I bet you what Pete Buttigieg, Buttigieg. Today's not my day. He's probably trying to protect that $550 billion at all costs, right? Because that's like his like ticket. But I agree. Like reallocation versus putting new funds in, right? It's just the same as when you look at your own portfolio, right? Like you could put new money in if you have a strong hypothesis on everything that's in there. But sometimes you go, this one over here, my uranium bet, maybe I should have had one less Coors Light before I decided to pull the trigger on that one.
Yeah. I'm with you.
Fishbowl on your side?
I sent you an article this week about non-farm payrolls. So basically the unemployment rate. And this graph,
beautiful mathematics.
This is in the Wall Street Journal. This graph, let me just give you, at the start of 2020, you're at like 152 million non-farm payrolls. It falls off a cliff to 130 million, and then it's gradually started to rebound. And what they did, and this is not the Wall Street Journal's fault, everybody does this, but it just kills me, is they just put a freaking trend line that says what we expect to happen over the next 12 months is a continuation of what happened the last 3 months. And that nonsense just frustrates me so much. So I guess this is just a mini rant on forecasting.
I wonder how many hours went into that.
No, there's people's job. There's like 12 people at a think tank in Washington that basically they could be replaced with a simple linear regression. Actually, simpler than that. They could replace with a toddler, like draw a line in the general direction of this. I just don't know why we give so much credence to forecasts, because the forecast in 2020 looked like a trend line that went up and to the right. And what actually happened is nothing of the sort.
It was, I can't remember what it was. It might've been the book, How Markets Fail. I don't know if you read that.
No.
But I think it might've been in that book, but they were talking about how human beings basically need predictions, right? In order to, so we love them. Like we love predictions, but we can never actually know anything beyond like even a year. And that's aggressive. So one of the, I think it was in that book, I could be wrong, but one of the things I was looking at was the like decade prediction going through the 20th century.
Yeah.
And saying, like, if you look at 1900 and what they thought 1910 would be like, and then if you look at 1910, what they thought, and every decade was basically impossible like to understand, right? Because the entire globe effectively like shifted during that time. Like no one knew who Vietnam was. Now we're in the Vietnam War. No one, and then like, it's like that kind of thing where you just go, like, you can never
forecast the Vietnam War. Yeah.
No. So just draw a straight line. Sure.
Like I completely agree. They're just filling a void. And so I guess there's demand for the forecast. My request from the listeners that want to be smart about this is to think about that every time you see a forecast and say, I know that's garbage and here's why, and hopefully not let it influence your thinking. But hey, if you want to like just tell yourself a good story, that's great. I'm not going to stop you.
Oh,
see what I did there, Doogles?
False narrative. Yes, like, aha. All right. I got one more fishbowl topic.
Let's hit it.
You ready for it? It's and this feeds into so many of the things that we've talked about over our lives, basically our investment conversations, but especially over the last weeks, we've mentioned a lot about, and today even we mentioned a lot about debt, a lot about foolishness, a lot about psychology, a lot about FOMO. I don't know if this is pronounced Archegos or Archegos. So we're going to go Archegos because it just feels fancy to me.
It sounds cooler, even though I think it's wrong.
Kind of like Dogcoin. Yeah.
Yeah.
So we're gonna go Archegos. Have you looked into this?
Oh, a little bit, man. Was it really 1 to 20 leverage? Was it really?
It's unclear. That's part of the thing. So I got a little bit of I saw on the periphery like some of the things that were going on, but they weren't adding up in my head, and that like I didn't put them all together. And then we got a little bit of listener mail last Sunday that also like that really tipped me onto what was going on. And even after we got off the pod last week, you sent me something that was like, what the heck is this? Which was also connected here, right? But there were all these like little nuggets. And so what basically went down, I'm gonna walk through some slight history and then like a timeline really quickly, and then start getting to the outcomes.
History lesson. Yes.
Sit down, people. So Bill Huang, who was he ran Tiger Asia, which is part of Tiger Global, like a really big investment, private equity, et cetera, just financial fund. And he ran that. There was some, I'm just going to call insider trading allegations, for which he had to pay about $40 million for. So then he left there and started a family investment office in 2013. And that's Archegos. So family investment office means it's basically just his money. So he had about $10 billion, I guess, that he wanted to invest at that time. And so this is a $10 billion fund he's running, just a good old family investment office.
I wasn't clear on that. Because a family investment, sometimes you're running other people's money. This is all his cash.
From everything I read, it's just his cash.
Okay.
His family's cash. Right. Okay. So that happened in 2013. Basically, from 2013 until March 24th, last week of 2021, like no one even cared. Like no one in the world outside of anyone that was dealing directly with him like knew this fund existed. It hasn't really done anything, right? Just a big old family investment office. Then what started happening was last Wednesday, these, what I'll call them like secret big block trades started happening. So on March 24th, Viacom CBS's stock fell. It had fallen like 9% the day before, and it was 30% off of its Monday high by the end of the day last Wednesday, right? And so basically people are just saying, these are nuggets I'm talking about. People are like, Viacom just dropped 30%. Like, what the? Like, okay,
yeah, for seemingly no reason, right?
Yep. Then on the 25th, so last Thursday, Huang had a conference call with banks saying like, can you hold off on selling shares because his swap trades, like he's hoping that they bounce back. And I'll get into like the swaps and stuff in a bit after I go through the timeline. Then on Friday, you see Goldman sell $10 billion in stock. Morgan Stanley sold $8 billion in stock. Deutsche Bank sold $4 billion. There's some others, but those are big block trades, right? So by market close on Friday, shares of Viacom CBS had fallen 50% for the week, right? So like huge drops. And this is still when folks are just like, what's going on here? There must be something behind it. So over the weekend, it started coming out of like, we think this is tied to an over leveraged hedge fund, and it might be Archegos. Started coming out over the weekend, but on Monday it became clear. There are some big losses. I'll skip a little bit, but so on Monday, Nomura Holdings said it probably lost about $2 billion, and Credit Suisse said it's going to be a big number, but they didn't give any more detail. That number on Tuesday, they disclosed as $5 billion. So that's like a brief timeline of the last week.
I just want to jump in. Just so, if I'm ever making this mistake, I want you to correct me, but I don't think you have to worry. So when I pay fines for alleged insider trading for 40 million, and then my net worth appears to be about 10 billion, if I think I need leverage to continue to grow my wealth at that point, I want you to throw something at me, preferably a shoe or something. Like, what is with these people and these banks too? Like, why is there a desire for more when you're talking about a $10 billion figure for your family?
Yeah. And to your point, they did throw things at him. Those things have to be their checkbooks.
And they said, and this is complete speculation, but I have seen a 20 to 1 figure. So let's just run with that crazy example. Like, your family is worth 10 billion bucks, and you can't sit around and do conservative investments and make 7% a year for the rest of your life. Like, you have to lever up and make things risky.
Dude, we're talking about FOMO. It's FOMO, man. And at some point, it becomes not about money. It becomes about a scoreboard, I think, for folks. And yeah, I mean, I think it's ridiculous. I agree. But on the point of leverage, he was using swaps, right? And I think there were other like derivatives he was using, but basically to give like from what I believe, from what I've read that he was doing, a swap in this case is a derivative instrument where you pay a fee to a bank and that bank will pay you back the return. And so if and that's where the leverage comes from, right? Is I'm paying you, I'm gonna make up numbers. I'm paying you $1,000 and you might end up paying me $30,000 if the thing goes up. Now, to the literally smarmy text that you sent me, like I think it was 4 months ago when I was texting you about the amount of margin debt, you said like debt only matters when things go down, right?
Yeah.
So here's an example, right? Basically what happened here is that he was highly concentrated in the leverage swaps, the bets that he was making in Viacom, CBS, Discovery, and then some Chinese tech firms. This also ties back to the what we talked about last time with what was going on with the China firms too, right? Yeah. So he was highly concentrated in these companies and their stocks started going down, and they were going down enough that the banks were like, we need our money back, like, or we need more collateral. I'll say we need more collateral so that you can secure what we're giving to you. And he was like, I don't have that collateral because the number I saw was 8. What you saw was 20. Regardless, they're both silly. Yeah. He was so over leveraged, and so he couldn't pay it. And so then they had to sell their stock in order just to have liquidity, right, and coverage. And so this is, I think, this is when we start to see how I'll call them small things, though it's big dollars, can cause big ripples, right? Because this was to go back to what I said before, this is a family investment office that was started 8 years ago that no one even basically knew existed until last week. And that caused significant losses, $5 billion for Credit Suisse, who's also been doing other silliness lately, right? Like significant losses that we didn't even know existed. And that's the second point I'll bring up is around disclosure obligations. And Yellen is starting to do some yelling around this because basically it's a family office, right? So disclosure of positions is looser, generally for family offices. We've talked about 13Fs, which is a disclosure obligation for hedge funds. But so it's looser there, and swaps make it like real tough to see what's going on, because not only does I'm just going to call him Bill. Sorry for the disrespect, but you're causing financial ruckus. So Bill basically didn't own stock. Like he didn't have the positions, first of all, and none of the banks knew what was, like, they couldn't see the full picture. And so the banks weren't even clear, because you have, whatever it was, like it looks like 10 plus banks that you have different swap positions on. So they don't see how much he's accumulating here. I mean, it's the disclosure situation here, I think is crazy, and the ruckus it can cause. One last stat, and then I'd love to get your view more. So we're talking about equity derivatives. I saw a stat in the New York Times that said the amount of outstanding equity derivatives, including swaps like he was using and other related ones, on stocks listed in the United States more than doubled from $50 billion at the end of 2015 to more than $110 billion during the first half of 2020, which was it's the most recent data from the Bank for International Settlements. So this is not just Billy Boy, right? This is happening in a more systemic fashion.
This is fascinating. I think I'm going to actually spend some more time on it, because I certainly am not an expert in swaps or derivatives. But if you think about like asset-backed lending, like a lot of times if I go into a bank for a car loan, one of the first things I do is make sure no one else owns that car. It seems like as the financial instruments get more opaque, it gets to the point where it's really hard to know what ripple effects might be caused. If you just talk about Viacom CBS, like that company was valued for a brief time 35%-ish less than it was the previous week, pretty much because of one guy with really only $10 billion, and some bank backing. Like, that is crazy. I don't know the market cap of that company off the top of my head, but that's a huge movement in
half
value.
Of what it was.
Gosh, it's crazy. Yeah. It's just crazy.
It's insane. Sorry for those that haven't seen it. We've mentioned it before, but The Big Short is it's a great way to break down some of this stuff simply. It was about the 2008 situation, which many people I think still think of as the housing bubble. But I think it's interesting, like that breaks down how it's like bet upon bet upon bet, and the opacity that can occur in the financial markets. Because here we're going 1 degree of how dangerous it is, but you can start to get to like he's betting through a bank that Viacom CBS is going to go up, and then others can take a position on his bet. In theory, I'm not saying that they did for this situation, but broadly, it just starts to get like you don't need all that. To your point, like come on.
Well, and I don't think all the banks understood that they might be effectively backing the same asset when it goes to the collateral piece. On the recommendation front, Big Short is great. I recommend the book more than the movie, but that's just me. Movie wise, I'd go Margin Call.
Is Brad Pitt
Margin Call is a great movie.
Is Brad Pitt in the book? Because if I can't see those cheekbones, why am I reading?
Oh man, yeah. Let's call it a day. Brad Pitt.